We all are very familiar with the concept of a diversified portfolio. Well, this is the concept of diversifying your cash reserves. Understanding that liquidity risk isn't a bad thing, and where can I maybe pick up a little bit of increased yield and diversify myself against any major unforeseen situations.
Yep. So you can go to Treasuries, backed by the government. So that's going to be your highest quality, least risk of default. And there's three forms. There's Treasury bills, which are going to be a few days out to a year out, would be Treasury bills. We've done some 3-month and 6-month laddering for select clients, primarily that have an actual need for funds outside of 3 to 6 months that want to take advantage of this inverted yield curve and theoretically, guarantee a return over those next couple of months, so long as the government doesn't default, which is an extremely rare scenario. Then we can go a little bit longer out there and look at Treasury notes. That would be 2 to 10 years. This is something we're typically not buying individually for clients, just like Treasury bonds that could be issued much longer out, 20 to 30 years. Instead, what we're doing is relying on the portfolio managers and the bond managers that we use for clients to make the decisions of Treasuries versus corporate bonds versus bank loans versus tax-free municipal bonds. And right now is an actually great environment for a bond allocator, meaning a analyst that can look across the landscape and look for discounted bonds, to Jeff's point, to look at bonds that are going to provide a yield that's fairly decent in a short period of time. So forward looking, we really believe this to be a great opportunity in the bond market. At least at Ausperity, our belief was that the bond market bottomed in the fourth quarter of last year and is beginning a recovery. So what's getting a lot of headlines is quote unquote risk-free investments like cash and money markets that could be yielding upwards of 4%. Well, what's flying in our opinion under the radar is that you have the Lehman aggregate, which is essentially the main index that tracks the bond market. That's up nearly 4% so far this year. Well, that annualized is on pace for a near 10% rate of return. So we're seeing that come back, but a lot of the focus is on what you can kind of access quickly or what investors appear to be risk-free, and that's typically just associated with cash type investments. So if you want to go really high quality, but give up a little bit of liquidity and kind of lock in a yield or lock in a return, you can look to the Treasury market and buy a bond from the government. And these are three various forms.
Yeah.
Thank you for watching our video. Please remember to subscribe to our YouTube channel. Look at our links below for ways of getting in contact us, and message us if you'd like us to add you to our monthly newsletter.